Okay. So do I need to repeat all of that? Okay, continuing. So welcome again, everyone, to this panel discussing central bank digital currencies. And I'll pass on to Ross Buckley. He'll be the MC for this panel. Okay,
thank you very much, John. Yeah, I'm Ross Buckley. I'm the KPMG Law KWM Professor of Disruptive Innovation at UNSW. And we are joined today, we're very lucky to be joined today by the representatives of the four major partners in an exciting new bank project on, sorry, can somebody give me some water? On central bank digital currencies. Excuse me. So immediately to my right is Chris Thompson. Chris is the Deputy Head Payments Policy Department at the Reserve Bank. Lisa Wade is next to him. Lisa is a Director at National Australia Bank. Claudio Lisco is next to Lisa. He's a Director of Strategic Initiatives and Solutions for ConsenSys for Australia and Southeast Asia. And right at the end of the row is Richard McCarthy, who's a Group Executive at Perpetual. A bit higher, does that make it better? Does that help? Water may help as well. Water helps, okay, good. So this project that these four organisations are on is a sort of feasibility project, an exploration of how feasible and useful a wholesale central bank digital currency might be in our country. And so we're all on the same page. I'm sure everybody here knows exactly what a CBDC is, but some people don't. And some people may reasonably say, well, I deal in digital currency all the time. It's all I deal with. I get paid in digital currency. I pay my mortgage or my rent. I pay for my coffee with electronic money, right? So what's the big deal? What's the difference? The difference is not the digital currency bit, it's the central bank bit. The only central bank money that Australians deal with is cash. Everything else we deal with is electronic promises of a commercial bank. Normally this wouldn't make a difference, you might think. Our systems, we have some of the best payment systems in the world on a day-to-day basis. But is that still not working? I hope we don't get okay. But I think what I always think of, and I can understand why the RBA is slow to move on this, if we'd had an account-based central bank digital currency in September 2008, when things were getting really, really wobbly, what would that have exposed the commercial banks to? Where might, if individuals had accounts at a central bank, what might have been the consequences of that? And you know, it's something that's always worth thinking about. I'm sure Chris does. So I'll hand on to Chris to give us the RBA's perspective on this exciting new initiative, a wholesale central bank digital currency.
Okay, thanks, Ross. I should note right at the beginning that actually this project that we're working on is actually has another partner as well, which is CBA. So it's CBA, NAB, Perpetual, ConsenSys, and the Reserve Bank of Australia. So we've got a project underway at the moment on a wholesale CBDC, but so we're looking at exploring what tokenized CBDC on a blockchain platform looks like, and the issuance and another aspect as well that we've explored is how you might make a CBDC token available to a broader range of wholesale market participants, potentially beyond the banks. Looking at that aspect, but the other important aspect of this project as well is we're talking about sort of bringing in a tokenized asset. In this case, we've looked at a tokenized syndicated loan. So so there's a process around looking at the origination and servicing of a tokenized loan on the DLT platform, and we've got both parts. So you can then start to explore, for example, what atomic DVP looks like, and some of the other sort of potential sort of programmability benefits that you might get from combining tokenized CBDC and a tokenized asset. In this case, a tokenized loan on a platform. So that's the kind of, in a nutshell, the project that we have underway. It's a step forward from the first project that the RBA did in this space, the beginning of first half of 2019. We did a sort of an in-house project. It was a sort of much more narrower scope project. And so we're sort of essentially sort of taking the research further to sort of help us sort of answer this question, I guess, which we're sort of on a journey to try to answering, which is, is there a case for a CBDC in Australia, with a wholesale or even retail? And we've had some thoughts about retail CBDC as well, which we can perhaps talk about as part of the panel. I should note that the project is sort of underway at the moment, where we're looking to sort of finish it very soon, and we are looking to put out a public report on the project, hopefully around the middle of the year. So we'll sort of everyone will be able to sort of see what we did and what our learnings from that project were.
Thank you, Chris. So Lisa, what's NAB's interest in this?
Yeah, good question. Well, firstly, I'm from the institutional part of National Australia Bank, and what we really wanted to explore was digital finance, programmable finance, I should say. And we're very interested in how blockchain can help us in markets where there are lots of inefficiencies. And we wanted to start with a syndicated loan because they're high value, low volume transactions. And there are lots of duplicated processes in the ecosystem, lots of errors or potential for errors, lots of operational risks. And so we very much came into this project looking at the utility of the CBDC from a wholesale point of view, just on those large transactions to remove those errors, save time, and very interested in, Chris was talking about the atomic DVPs, very interested in the atomic settlement. And I see Nick walking in the door, who is the mastermind behind the atomic settlement. And we were very much interested in looking at that aspect of it.
Okay, thank you. Now, Claudio, can you tell us a little, I know ConsenSys has been working in the region on some other applications, so would you like to go into those?
Sure, thanks, Ross. So I think we're talking now about the project here in Australia, and the focus there being around the interoperation of tokenized assets and CBDC. In parallel, we also have other projects with the Hong Kong Monetary Authority and with Bank of Thailand as well. The one with the Hong Kong Monetary Authority is actually expanding fairly significantly now, and is focused on cross-border transactions. So the HKMA has involved Bank of Thailand, but also they're working now with the Bank of China and the central banks of the UAE. The context there is using CBDC tokens denominated in different currencies to facilitate cross-border payments and payment versus payment scenarios. And I think this project is particularly significant because obviously it has an international collaboration, and it has the potential to really drive learnings that can go beyond specific national applications and extend to also the Bank of International Settlement and other parties that are obviously critical in the advancement of these protocols and global jurisdictions. Then with Bank of Thailand, we have also done a project that was specifically focused on the Thai market, and in particular focused on retail application of CBDC. In that case, there was a lot of interest in exploring the scalability aspects that in many previous projects have proven to be a significant limitation in the adoption of these type of solutions. And it was remarkable there that as part of the implementation that we did with Bank of Thailand and the way we had configured the distribution of CBDC, we were actually able to reach very significant level of transaction throughput and effectively demonstrate that a CBDC solution will be suitable also for retail use cases, at least from a technical implementation perspective.
Okay, thank you very much. And finally, Richard, I'm guessing Perpetual is in this because Perpetual is a potential large user of this technology. Is that right?
Yeah, that's right. So,
put that on. The blockchain technology, I've been exploring it as a trustee, custodian, and agent. We enable a large amounts of payments from the banking industry through to the institutional investment community. And what we look at is, back in even 2015, we started talking with ConsenSys around, how do we improve the market efficiency? How do we connect the ecosystem so you can create more transparency, more operational efficiency, both at the payments level, but also the registry level. And obviously the registry level using the distributed ledger technology, how can we improve the ecosystem that way while improving transparency and efficiency? So we've been looking at a number of exploratory initiatives over the years, and including great to see sort of the regulatory legal frameworks coming so far now with the technology to actually enable this type of exploratory work with the central bank. So for us as a key intermediary within the market, we're very interested around how do we take this great technology and actually bring it to life within the ecosystem so it actually provides benefits across all parts of the communities.
Okay, thank you. And just to be clear, this project is looking at a tokenized wholesale CBDC, not an account-based one. That's right. And what's the perceptions of the benefits of a tokenized one rather than an account-based one for this wholesale?
Well, from a NAB point of view, we came at it, as I said, from the trade, and we were looking to and exploring ways we could work with a syndicated loan. And it became really obvious as we were mapping and planning the transaction that the real benefits would only be realized if there was a central bank digital currency that was tokenized. Otherwise, we still had the whole layer of process of having to work with APIs to do the settlement. And yes, we can do that, and it would have been still great. However, to really bring the operational efficiencies we wanted to, we realized that we needed that utility of the CBDC. And so we pursued this project so that we could achieve that utility to make the change we wanted to in the syndicated loan market.
Yeah, and I think, if you take it at a higher level, it's the asset, which is basically, so a lot of what we do is in securitization. So you securitize accounts, that's going to be hundreds of thousands. So, an asset of a loan is, again, as Lisa said, it's much simpler to basically, go through the keyhole and actually proof of concept. And then you can look at other assets, which potentially can be tokenized.
Yeah, for sure. I mean, on this whole discussion on tokenization, on tokenized, I think there's different definitions of tokenized here. I mean, this what we're doing, I think you would characterize as actually probably more like an account base, because at the end of the day, we're talking about tokenized in the sense that these are CBDCs, tokens on the blockchain platform, but there's still accounts essentially linked to, people have to sign in and prove that they own the account to actually operate to move the tokens around. So in a sense, it's probably would more be called an account-based system in that sort of strict. Is it a token or a account-based system? I guess here I'm thinking of, when I think about tokenized in this context, I'm thinking about something like notes, for example. Physical bank notes are a sort of a token. You don't have to sign in to use them. The only the verification that you have them is, well, you've got them in your hand, and there's some sort of counterfeiting sort of aspects of it to prove that you haven't sort of counterfeit the notes. That's a sort of true tokens-based system, whereas account-based is where you've actually got to prove that you own the account to actually move the tokens around or move the CBDC around.
Yeah, and I think for us, it was the conversation the tokens can have between each other with that programmability inside the smart contracts to remove the error of the human conversations is where we really saw the benefit.
Yeah, thanks for that, Chris, because one of the things I found myself doing for the first time in my long career in the last 2 years is writing taxonomies. And so many of my bloody articles these days begin with 5 pages of definitions of what are we actually talking about.
We have a taxonomy swear jar.
Do you?
Yeah,
oh, did I just breach it? Did I? But it's really a strange thing. It's like I've practiced in finance law all my life, but I've never, until the last few years, had to think really clearly about what we are talking about by different terms. And people often miss each other because they're using the same term. You explained it very well. In the China case, China is doing its DCEP, Digital Currency Electronic Payment System. It's tokenized, but it's retail. So that is the second example Chris gave, where if you're going to have a retail system in a place like China where electricity goes out, where internet is not so, you've got people in remote areas, you need something that actually lives on a phone. That is analogous. That token which lives on a phone and can be used when there's no, internet connectivity or whatever, then really does function more like digital cash than this sort of thing.
If I can add to that, though, when we started the project, I think from a technical perspective, we took a deliberate design decision to work on the concept of a tokenized CBDC, because yes, Chris is right. In the current project is acting more as an account base, because you still have those account-based rules to access and distribute the token. But we see that model to be a model that is more prone to different applications and different extensions. So that's why we decided to go that way, and we see future in that type of models across the globe to become the predominant ones as well.
Yeah, I think, and I agree entirely, because we are moving into a smart contract. I think Lisa might have mentioned the term smart contracts. Smart contracts are not typically entirely contracts in themselves. They are self-executing pieces of code that, in my view, complement a contract that sort of exists outside the code, but they're very powerful. So a good example, Philips in Holland is working to move all of its supply chains onto smart contracts. Payment would be when the shipping container comes in, scanners can scan through the steel of the shipping container's sides and work out the atomic composition of what's in the container these days. So it can work out whether what has been shipped is precisely what was ordered. And if it is, then they can effect payment or automatically, which would obviously be enormously attractive to suppliers because all the delays get cut out. That payment is going to work better as some sort of tokenized CBDC that exists in the same blockchain environment as the smart contract exists. I mean, obviously it's not essential. You could step out of that. I know, and I'll of course defer to you, Claudio, because I'm a lawyer and what would I know? But I think you could still step out of that blockchain environment to effect the payment, but it's a lot easier to stay in the environment. So it seems to me that's where we're heading, isn't it, long term?
Definitely. And I think there's still many conversations happening on whether, you really need to digitize the money and you really need that type of, all assets on blockchain environment to achieve the benefits. And I think the reality is that in the middle term, you probably don't need to go to that full extent, right? Because you can still create interoperations between, new assets on blockchain and legacy payment trails. But then if you really want to achieve the full benefits and full scale of transformation, probably in the long run, we will see all assets, including cash, transition into a blockchain-based ecosystem to facilitate that type of transaction and that type of smart automation that you can achieve through smart contracts.
Yeah, and I just add, and this is what Lisa said earlier, because essentially the explorations and proof of concepts we've been developing essentially is the asset on the blockchain, but then the payment outside. So you're basically coming off basically a piece of technology to then process a payment through basically the RBA Risco via real-time gross settlement, and then you're watching payments in two different places where, as Claudio says, ideally to create the true benefits to the ecosystem end to end, then that would just be a seamless automated workflow.
And it's right that you're starting, because China's been on its project for 7 years, as far as I can work out. And it's trialing it now, but it's been working hard on it for 7 years. These are not simple things that can be done quickly overnight. But we've probably spoken for long enough up here. So over to you people, or over to the people online. If you're online, please type in some questions. But for people in the room, this is your opportunity. What else do you want to know? Yes. Yes, I was intending to do that. The question is the Reserve Bank looking at specific public technology, or what was the next part? Okay, or is it bespoke internal technology?
Well, I mean, I'm not great on the technology side, so Claudio will be better able to answer this. But I mean, the project we're doing at the moment is using, the Ethereum blockchain. It's also using some technologies that ConsenSys have developed with Ethereum. So I don't know if you'd call that pure public or partly proprietary, but it's but yeah, we're not developing it internally ourselves in the building. We've got a technology partner in ConsenSys who has been helping us with that.
Yep. Not much to add there, to be honest. Like Chris' answer was perfect. Many of those components are actually open source components. So we'll be able I mean, anyone will be able to use some of those components and replicate or integrate with the type of systems that we're using today. So it's definitely not looking at a fully proprietary solution.
Okay. Yes.
No, it was a private version of Ethereum using Hyperledger Besu, which is a version of the enterprise Ethereum implementation that corresponds to the Enterprise Ethereum Alliance specification. It's a piece of software that was developed by ConsenSys, but it's actually open source. So anyone can run Hyperledger Besu chains. And we use the scalability that can be implemented and achieved through Hyperledger Besu to perform to achieve that level of transaction throughput that was required for the project. Yeah, correct. Yeah. So using different consensus mechanism, that the one that the public chain uses, you can achieve a higher level of transaction throughput.
And yes. Are the online people getting the questions from the audience, or should? Sorry, I need to repeat it. Okay, yeah. Why don't we circulate one of the mics so that so the question? Well, why don't we give the mic to the questioner again, and he can repeat it.
Thank you very much. So the question was, as you think about integrating with different smart contracts, how are you thinking then about the trade-offs between public and private blockchains, and how either will work with a CBDC solution?
Well, from my point of view, and this is a personal point of view, I think about interoperability a lot, and that's something we've been focusing on. There's also a question up there about the types of chain. It's really important that to note that for NAB, this is a proof of concept, which means it doesn't sit in our internal systems, and it's a research project for us with an output of a report, as opposed to testing any internal systems, and we're working with ConsenSys for that.
I think also to expand on that question, it very much depends on what you're trying to achieve with the project and the implementation, right? So on the case of CBDC solutions and the current state of experiments across the globe, most of the implementation rely on private chains because it's obviously a more controlled setup. It also had the advantages on being able to replace the consensus mechanism, as we were saying earlier, to something that can achieve the transaction throughput and achieve the speed of consensus formation. And then I think the third benefit is also some additional controls on the privacy side and the visibility of the transaction, even between the parties that sit on the chain, right? Obviously, the drawback to that is that you have a system that by definition is private and permission, and therefore cannot fully interoperate with everything else that is happening on a public chain, at least at this stage. So if we're looking at what is happening in the DeFi ecosystem or in the space of the NFTs and the digital media world on public chain, if you wanted to use those CBDC solutions right now originated on private blockchains, there will be some issues in terms of interoperability. And that's why the ecosystem in general is also running on stable tokens like DAI or USDC, which in many ways are supplementing the lack of other forms of cash and digital payment methods on chain and facilitating the type of transactions.
Yeah, I mean, this probably sounds like blasphemy at a blockchain platform, blockchain conference, but I mean, I think the jury's also out on whether or not you would use blockchain technology for a CBDC. I mean, there's not a lot of information out there on the Chinese project, but my understanding is that it's largely a centralized system. So, I think we're definitely keen to explore what does blockchain technology buy you you know, in terms of CBDC, and obviously our projects to date have been using that technology, but I think the jury's out on whether it's the right technology for a CBDC.
Yeah, that's such an interesting comment, because I started as a completely wholesale person and I didn't think that there would be a use case for a retail CBDC. And during this project, I've actually started to realize one of my former colleagues from about 25 years ago is over there, and we used to trade back in the day. And my old boss used to say, if you don't, somebody else will. And what I really see with what we're learning about the utility of the tokenization is that it's really necessary for DeFi to function the way it can to its full potential. I see that DeFi is the future of finance. And so I believe that if we don't start building central bank digital currencies, that people will just use alternative mechanisms. And I personally would rather see sort of stable and secure tokens. So I've actually gone the whole circle, 180 degrees, and now I'm a believer in the retail CBDC. So that's a turn up for the books. I was probably the naysayer at the beginning of the project.
Well, it's a good point, Chris, because the last time I looked at, or the most recent report of the Central Bank of Sweden that I've read, says clearly the Central Bank of Sweden is not going to use blockchain, because it says blockchains are really well adapted to address trust issues, and the central bank doesn't have a trust issue. And it notes in there that it has produced the means of exchange for this part of the world since 1428 or something. They're clearly very proud of it, and they're not going to stop producing the means of exchange, and cash is going down the gurgler in Sweden. So we're going to have a retail CBDC in Sweden very soon, I think, within the next couple of years. And that'll be a fascinating development, because it's a sophisticated economy. They'll make it work. They get things right. Lisa?
Well, there's a question up there that I think really suits this. And the question up there is, what does the advent of programmable money mean for the financial liberty of future Australians? Now, no one here is going to want to really answer that, because you start getting into the social license to operate. One of the things that really fascinated me is you can talk about Libra, DM, whatever they want to call it. They'll change it every time there's bad press. Sorry. But one of the things that really jumped out at me was the way they spoke to the social impact and financial inclusion and the social benefits of a CBDC. And I think that this debate here is going to be huge. And it really gets me thinking about like social licenses to operate and who has the mandate. I mean, money is a construct between, you know, us, you and me. If I say that $1 is worth $1 and you're willing to give me a coffee, then and I pay you that amount of money, then that's what it's worth. And I think it's going to be a really interesting conversation, and but probably a little bit off piste for this today.
We've got some questions from the online audience up there. Does anybody else on the panel want to jump in on any brave?
I might read some of those out. So stable coins versus CBDCs. Why not stable coins? Anyone want to proffer an answer to that?
Well, I can say something on that. And it kind of goes back to what Ross said at the beginning. I mean, you know, the value of a CBDC is that it's issued by the central bank, and it has that protection. Stable coins are, you know, supposedly supposed to be very safe. They've sort of got certain design constructs to sort of try and to generate that. You know, they're sort of holding assets that, you know, one for one that back the coins on issue, etc. So they, but you know, they're not issued by a central bank. You know, and so that's the difference, I guess, to my mind. Some people are, you know, will prefer the security of a CBDC potentially. You know, stable coins, you know, will have their place in the market. I mean, we've seen a lot of activity in the stablecoins market recently. And, you know, and Lisa mentioned the sort of the Libra/DM proposal, which is very much focused on that cross-border payments, improving the efficiency, you know, reducing the cost of cross-border payments and remittances, which is a market that you know, probably hasn't been well served by financial institutions in the past. So they'll have a place there, but they're not CBDC.
I also think it comes back to that point of issuer and who you trust. I know we talk about blockchain creating a trustless ecosystem. However, you're still dealing with the issuer of the stable coin and what is the underlying. And I think that that's really important. It's very important to me as somebody who believes in stable financial systems, that we have stability in who the issuers are. And I think that, like I said before, the people will decide what they place value in. I mean, we could build a central bank digital currency retail version and people may not use it. They may prefer to use a stable coin that's issued by somebody else. And that's everyone talks about first principles. I think we talked about this before, but the source principle of money is that the people decide the value of money.
My view on stable coins, they've got to be a bit more expensive because there's all that collateralization by putting fiat currencies. That's got to cost some money. I think the huge opportunity for stable coins is what Chris mentioned, remittances. You know, the remittance corridors between Australia and New Zealand and the Pacific are among the most expensive in the world. 8 or 10% it costs often for people working here to get their money home. Stable coins should be able to blow that completely out of the water. That'll be their first application, I think.
I think this is an interesting question. The Reserve Bank's under pressure to create a blockchain token or risk losing control of monetary policy.
I don't know if it was a question or a statement, that one. I mean, I don't think that's a significant concern for us. You know, I mean, the reality is if there was a lot of people all getting into some foreign currency denominated stable coin or other digital currency, then we might be sort of thinking about those issues. But it doesn't seem plausible that Australians want to move the majority of their wealth into foreign currency denominated coins that are potentially issued by some foreign entity. So I'm not sure that's not really I wouldn't say it's a big consideration in our current sort of research in this area.
The limitations placed on the CBDC pilot due to well-known Ethereum scalability issues or to risks in a broader experiment with a crypto Aussie?
No, and the reason for that is you've got to start somewhere, and it wasn't about constraints. It was about it's never been done before, so we needed to start somewhere, and we started at the first place, which is a POC.
Just wait a second. Thank you.
I realize that this project is running on a private version of Ethereum, but CBDC is quite a hot topic around the world. Are there any, in the panel's opinion, are there any emerging protocols that are specializing specifically in CBDC? Because it sounds like you've kind of retrofitted or customized the private version of Ethereum to it, which sounds like it's scalable because you don't have the gas problem. But are there any protocols emerging that are going, we're going to win the CBDC race?
I mean, so the honest answer to that is that there are experiments and pilots and proof of concepts happening on any protocol, right? So there are central banks experimenting with Ethereum and private version of Ethereum like Quorum and Hyperledger Besu. There are other central banks that are experimenting with Corda and the R3 ecosystem of solutions. There have been experiments also with Hyperledger Fabric. And I think it's fair to say that that type of experiment is probably slowed down at this point. I don't see there are many other projects happening right now on that technology, at least from what is public and visible. There are also central banks that, as part of the many things that they've experimented with, have experimented with public protocols. So with the public Ethereum blockchain or with Tezos, like in the case of Bank de France, for example. So I don't think there's a protocol that is emerging right now as the winner. Maybe I'm biased toward Ethereum and I see many projects happening in the Ethereum space right now. But yeah, I think it's still very much up for discussion and for future developments.
Yeah, and as a non-biased person, because I'm not working in a technology company, I think there are as Claudio said, there's lots of exciting things going on. And I think we need all of those exciting things to happen. And that's why we think a lot about interoperability and how we're all going to operate together. I think that's the amazing thing about DeFi is it's just happening across so many different pockets with so many different people creating new opportunities for themselves and for all of us. And I think that interoperability is probably the thing we should all be thinking about.
I have a question and a statement. Lisa, you are my new hero. Where are the bankers like you? We've been few and far between. We've had this conversation in rooms time and time again, and people are hidden in the corners or in the back rooms. Where have you been all my life, and where are the rest like you?
I can't answer that. I didn't want to go red, and now I'm red. It's much easier sitting at home on the Zoom. And Claudio is my partner in crime.
One more question, John?
Yeah, I'll read half of this question. So as a retail customer, why would I want my records to be on the blockchain? If we were to move to a retail crypto central bank digital currency. If as a retail customer, why would I want my records to be on a blockchain if there was a retail digital currency?
I guess this is sort of all comes down to it. You know, it's part of the design choice of how you set up a retail CBDC if you did it. I mean, there's sort of these questions about anonymity and privacy, to what extent you allow that. Would be obviously an active debate we would have to have if we were pursuing a retail CBDC. You know, I could imagine many people wouldn't be comfortable about having their transactions on a public blockchain. But, you know, if it's some private one, which, you know, only sort of, the entities that were distributing the CBDC could had access to, or maybe they'll be happy. I mean, currently everyone's account, their account details are known to their bank, and we have rules around privacy. And so this is all just, a question of how you design it and what degree of privacy, and anonymity that you build into it.
It's a very good question if we flip it to the wholesale CBDC in the trade context, though, because in the trade context, who owns the data is going to be really significant, I think. And one of the things that might force Australia's hand in the longer term, China is already starting to trial its CBDC in offshore use. China will subsidize that as a payment. It's not interested in any income from it as a payments mechanism. Playing a long-term game that has to do with dethroning the US dollar and stealing back the exorbitant privilege the US gets from minting the global reserve currency. So if China uses its digital currency and makes it freely available, which my guess is it will, in international trade, people will use it because why not? And the data will end up not in Washington or Canberra or Ottawa, it'll end up in Shanghai or Beijing. So who you trust to look after the data and to know the data ultimately is going to be a big thing, I think, in shaping this. So in that sense, it's a right on the money question.
I think that same principle applies also to the retail example, right? Because I will be more comfortable knowing that my data is on a blockchain and I can have visibility of where the data is at and who is accessing it and who controls it versus knowing that the data is on a Visa database somewhere that could be hacked and manipulated in any type of way. So,
yeah, and I think you've got trusted institutions, obviously Reserve Bank, and that's where you've got companies like Perpetual as a trustee company. We actually think this is the evolution in terms of the DeFi evolution, where companies like Perpetual as a 130-year trust company will actually now start looking at the digital ecosystem and digital currencies to actually provide those independent roles to the market. And then that's one of the things obviously we're interested in the market is what is that? We provide a data warehouse function at the moment for data. And that connects the banks to the Reserve Bank. We just see this as an evolution to that going forward.
Okay, very good. How are we going for time? One more question, or are we out of time? One more question. Okay, lucky last.
I was just interested, going back to Chris's statement that the jury's out on whether blockchain is the best architecture or operating model potentially for a CBDC. Particularly when you look at the wholesale context, I mean, you've already got a database for wholesale currency, right? And RITs, and you've got a system around that. So what change to that? Or at what point does the set of properties suddenly make that become a CBDC versus not? Or put another way, like if it doesn't depend upon a decentralized operating model, then what does define a CBDC in your view?
Yeah, well, I mean, it's a good question. I guess you're sort of making the point that, balances in exchange settlement accounts with the Reserve Bank is CBDC, the form of CBDC in a sense. But yeah, I think if it's been issued on a blockchain platform, which we've been experimenting with, I guess that's, it's a different form of CBDC. It's a different system to RITS, which is a centralized system run by the bank. So yeah, I mean, I don't know if anyone's got anything else to add on that one, but it's a, CBDC to my mind there's different forms of central bank digital currency, and this is where we're experimenting with a new form and trying to discover whether there's benefits to it and what the other implications are.
I think also from a kind of like definition point of view, you can look at CBDC in terms of a blockchain implementation when you have a central bank still being the issuer of the currency, but then a pool of parties acting together to maintain the infrastructure that runs that currency and runs the operation of the entire system. So you don't have decentralization in the issuer of the currency, but you have decentralization at the level of the system that runs and operates that currency. I think that's the main definition from, the main difference from a digital currency that is issued by the central bank, but operated on legacy systems.
And my one answer for that is that tokenized money contains a program which can talk to other digital assets, and digital money does not.
So the difference is the tokenized.
The smart contract that sits inside the token. Yeah, that's the important thing that allows the conversation to happen between the money and the asset, and that's what will create digital finance, and that's what we're interested in, or programmable finance, I should say.
So on that note, with Steve Vallis's new favorite banker, we should wrap up this session, and we're going to move on. So thank you very much to all of the panelists. Thank you. Okay, so we're continuing. Give people 1 minute. People in the room. Okay, thank you very much. It's my privilege now to interview Joni Pirovich, who is a special counsel at Oakley in private advisory, blockchain and digital assets. So we're going to move on from some of the questions in the previous session to a retail CBDC. And what's the social use case for a retail CBDC? So Joni, your views?
Well, Lisa's my favourite banker too, and she really did my job for me in setting out the public policy case for a retail CBDC, which I'll just call a digital AUD. And I think really it's to give Aussies and Australian businesses the chance to participate in the digital economy. And the longer that we refrain from giving Aussies this ability and education and opportunity, the more we're going to get left behind, or really just stuck in friction points that are really not helpful for innovation. And so I think that the main point, as Lisa said, was the programmability. And I'm a lawyer, and I think, Ross, you said, what do I know? But here are some of the things I know based on the clients that are coming to me to try and get some certainty. We've got people with ETH, quite substantial values of ETH, that are wanting to interact with lending protocols. You might have heard them: Maker, Compound, Aave, and it essentially requires the deposit of ETH into a smart contract to mint DAI, a US dollar pegged stablecoin. It's algorithmically pegged. And often that DAI will then be sold on an exchange for AUD, and individuals are using that to purchase Australian real property outright, to fund some of their business expenditure outright, at often what we're seeing as more affordable rates and on better terms than the existing commercial banks are providing. Now, there is smart contract risk, there's technology risk, there's cyber risks. There are a number of risks to be managed, but that relative simplicity of depositing in ETH to mint DAI, sell it for AUD on an exchange, and buy something outright, there's a simplicity to that. These interfaces, they are often operating in the realm that is yet to be regulated. And what that also means is, whilst they probably need to have certain minimum disclosures if they were regulated entities, currently they don't. And the interfaces are actually quite simple. And so you understand exactly your liquidation price of ETH, that if the ETH price in the market was to get to that stage, that your ETH in that smart contract would be liquidated. And you're aware of it, and you can manage it. And there's a stability fee where that rate is actually dependent upon how much ETH value is locked in the protocol. Now, I just give that example because it's lending for individual needs as well as small to medium business needs. This is a key function performed by our commercial banks. And the two digital assets that I've spoken about, ETH and DAI, are no way referenced back to Australian dollars. So we don't have any observability of Australians using these protocols for lending, a basic function in our financial markets. We don't have skills in the toolkit yet to understand how monetary policy might be informed by Australians' use of these protocols. All we might have as a proxy is the number of Australians that hold ETH on an Australian digital currency exchange, that transfer it out to the smart contract address that's, say, built by the MakerDAO team. All we can see is the amount of ETH going out to those smart contract addresses as a proxy of how many Australians are using lending protocols for lending instead of commercial banks. Yes, it might be minimal number of Australians at this stage, but the numbers are growing, and the rates and terms, there's no fixed time to repay principal and interest. You pay as and when you can. It's flexible, and yes, there is risks. I'm not here to endorse any one product, but I'm just seeking to communicate what is happening, and to show, as Lisa was telling us, that DeFi is commercial in-flight testing to the billions of dollars worth of value now of financial, capital, and banking technology infrastructure. And so, like Lisa, every big bank should have a person or a team looking at what's going on in DeFi, because in maths we trust, and in those algorithms, the rates and the transparency at which lending products, financial market transactions, capital market transactions are able to be conducted are proving to be much more efficient. And I'll let everybody comment and and provide me on that. But some of the language that I'm also using is the language of money, and yet we don't have legal or tax recognition of cash equivalent use of digital assets yet. So there are a number of unintended tax consequences popping up for people interacting with lending protocols, thinking that it should have the same economic tax consequences, the economic intention. In my tax session on Thursday, I'll be going to some of the severe tax consequences that are possibly happening. And then the last thing I'll mention with what DeFi is proving out is, I've mentioned lending protocols, but there's also banking or deposit type protocols where the language is you stake a digital asset and you earn yield in that digital asset. This is the business of banking. And I have not seen guidance from APRA yet around the regulation of smart contracts being used in a similar way to deposits. And there's a protocol called Yearn. This will automatically figure out where your liquidity or your digital asset wealth should best be stored to earn you the best yield. Yearn is a protocol that self-executes automatically to move your wealth to the platform that gives you the best yield. Imagine the next iteration of Yearn for lending protocols where it automatically moves your lending position to a protocol that gives you a better rate. So back to our traditional state of regulation, responsible lending requires platforms to show comparison rates and sets out terms and conditions for consumers to have dispute rights if anything should go wrong or they're harmed, but it's costly and time consuming for them to exercise their rights. And so ASIC has also consulted and has recently finalized the consultation, excuse me, so much to say, on design and distribution obligations. And that's going to produce more disclosure obligations upon regulated entities, financial services providers. And I would say that one of the public policy cases is, do we really need more disclosure and more dispute rights and more talking about those things when DeFi in Maths We Trust is proving that it can get best deal for customer on a number of fronts?
I think part of the problem you're facing with the people who are making the decision is they didn't do very well at maths in high school. I'm not sure your premise of in Maths We Trust holds, but it's a very thought-provoking comments. Well, a couple of years ago, I started to notice when I was buying coffee on campus that there's always a long line at the place that has good coffee. And often the Chinese students lined up in front of me would be paying with WeChat. Now it's not DCEP, it's WeChat. But that's been going on 2 or 3 years. That money is not touching down in the Australian payment system at all, right? And I suspect very few people in Australia know that's happening or understand it. I'm sure I'm the only nerdy sort of person in the coffee line who thinks where this actually goes and how this actually, but these changes are coming and some of them have been here for a while. We've got time for 1 or 2 quick questions for Joni. So no questions. Oh, Steve is not my favorite person anymore. So we have to wrap it up there, do we? Okay. These guys are brutal. On to the next session. Thank you. Thanks to everybody and thanks online.